Yeah, this corporate bonds actually has some kind of continuation even into the valuation also, where you do a lot of valuation of the bonds. So just trying to understand some of the terminology and some kind of different features associated with the bond is what is covered as a part of this part 3. So looking at bond, the initial thing that comes is an indenture, which is more like something that contains all the details of the bond, the obligations of what the issuer will be doing and will not be doing, the do's and don'ts of the issuer. So it's more like it's more like kind of a prospectus. Apart from the prospectus, it even clearly specifies what the issuer will do during this period and will not do during this period. So there are some kind of do's and don'ts on it, which are called as covenants. So every indenture, it's like a one-stop document for the bond. So indenture is like a one-stop document for the bond, which will have some covenants, which are typically positive covenants as well as negative covenants. Positives are what the the issuer will have to do. He has to maintain some ratios. He has to maintain he should don'ts wise, negative covenants wise, he should not issue new loan without informing the existing bondholders, or he should not give more and more dividends. So some kind of do's and don'ts would be there as a part of the bond indenture, as a part of the different covenants. So it sets forth the obligations of the issuer. So every bond issue will have a trustee, whose key role is to interpret the legal language of the indenture, which will the bond shall do this, the bond shall not do this. So from a legal standpoint, he takes care of every wording in the indenture is adhered to, and work sure that the issuer fulfills the obligations. So the issuer wise, what all would be there? Okay, I'll pay you. You have to pay me this much for each bond today, and probably on maturity, this bond will have a 5-year maturity. On maturity, this much amount would be paid, and in the meanwhile, some interest would be paid every year. This is what is the features of the bond. The trustee's role is to make sure that the issuer does not default because he has taken the amount. So making sure that the issuer does not default and the payments are done promptly is what is the role of the trustee. And bond issuer's obligations are fulfilled on the maturity date or before, because before, in the sense, the bond could have a call option on the bond. So the issue, because of this, the issuer can call back the bond at a particular date, or on or after a particular date. So it need not be up to the maturity date. If the issuer thinks that the bond is beneficial to him, he may very well think of calling it back in the middle itself. And bond can be retired before that date. He can call back with a call provision on the bond. The bond can very well be called back and can be retired even before the maturity date. Okay, what is the role of a trustee here? He is a third party to the contract. It could be an organization, it could be a trust. It's a third party to the contract, and it acts in the fiduciary capacity of the investor. So its role is to protect the rights of the investors. Because see, let's say if L&T has issued bonds, we have purchased the bonds of L&T. We don't involve in the activities of L&T, neither we have access to anything of L&T. We have simply purchased the bond, and that money has gone to L&T. L&T has to execute some projects, and after that, probably after 1 year or 5 years or 10 years, they will pay us whatever they have mentioned as a part of that contract. Who will make sure that they will pay? They can very well fly off with that money. So in that case, there should be someone who is protecting the interests of all the investors, because you are not day in and day out going to L&T and observing what they are doing, or is your money safe or not. We are not monitoring. The investors wise, they have just purchased them, that's it. So there should be some kind of a trustee. The trustee's role is primarily taking care. So if the company, if the issuer is not able to pay, then the trustee will be held responsible, because it's the role of the trustee to make sure that the investors' interests are protected. Authenticates the bond issued, that these guys will pay. It's a bank or a trust company. It could be a bank also. They are authenticating that it's okay. L&T bonds are good enough. Not rating. Rating is different from trusteeship. They are only irrespective of the credit rating and all of the company. They take the ownership that this company will make the payments. Only that part. Only the legal aspect. It could be a bank or a trust company with a corporate trust department and officers who are experts in performing the trustee functions. Ensures that the issuer complies with all the covenants, both the positive as well as negative. All are to be mentioned, whether the bond can be called back in the middle or not. Even that has to go as a part of the indenture. Right? Otherwise, the issuer cannot do anything in the middle that is not written as a part of the indenture. So it's more like a complete, full-fledged guideline document for the bond. Only after reading that entire indenture, which typically is a prospectus and few other stuff, unless the investor reads through all that stuff, it's not good to invest in that, and it is assumed that the investor has read all these things before he goes forward for the investing. Yeah, the corporate bonds could be of different categories. Some can be issued for public utilities, which are generally issued by the government, or even corporate also. Probably the metro rail, if they are issuing some kind of bonds for L&T metro rail, they are more for public utilities. Some transportation, some industrial specific, some infrastructure specific. Bank and finance companies can give some kind of Shriram Transport Finance issues so many bonds. LIC Housing Finance issues some bonds, or Power Finance Corporation issues bond. They are for public utilities. So that money they will use for these kind of industries. Sometimes they may even issue a bond for investing in international also. So the investment from a company can be at different places from the money that it has taken. But in the indenture, they have to clearly specify for what purpose. Right? If a Mahindra Finance is issuing a bond, for what purpose they will use this entire money. So they will have to clearly specify. They will not use it for equity trading purpose. It has to be a part of their core business. Right? So every bond will definitely have a maturity date, the date on which the principal amount will be paid, and until that time the interest will be accumulated, either paid or accumulated, but the interest will be stopped from that day, whatever is the maturity date. After that, the interest will not be applicable. So that bond will be terminated. The difference between again bond and an equity also lies there. Equity is almost forever, whereas the bond will always have a maturity period. Maturity date tells you when you will get your principal back, for how long you will receive interest payments. So up to 5 years, let's say if the bond is having a 5-year maturity date, you will get your interest either getting or accumulating, either way, for 5 years. And at the end of 5 years, the principal would be paid back in any typical corporate bond. Yeah, the interest payments wise, there are different types. Actually, the periodic interest payment in a bond term is called as coupon. The periodic interest, every year or every semi-annual or every quarter, whatever is the mechanism they are using for payment, every periodic payment is what called as coupon. So there could be different names like straight coupon, where whatever is the coupon amount, they say 8% or something, if they specify, every year that 8% would be paid. That's a straight coupon. Zero coupon is nothing is paid every year, only at the end a lump sum amount is being paid. Nothing is paid in the middle. So yearly payment is what we are calling as the coupon. So when I say straight coupon, some percentage will be specified and that percentage will be paid every year on an annual basis or on a semi-annual basis. Whereas in case of zero coupon, even if it is a 5-year maturity bond, nothing will be paid in the 5 years. Only at the end of 5 years, the total amount will be paid. That's a zero coupon, which are more like our FDs and all. Generally, even if I take a 5-year FD, I won't get anything in the middle. Only at the end of 5 years, I will get the lump sum amount. And floating rate bonds, where the interest rate every year could be floating. Straight coupon means every year it is a fixed amount. Whereas in a floating rate, the interest rate which you are receiving every year would be different. So straight coupon bonds pay a fixed cash coupon periodically. Floating rate bonds pay a cash amount that varies with the market rate. So this year if the market interest rate is 6%, they will pay a 6% coupon. Next year if it is 8%, they will pay 8% coupon and so on. Zero coupon bonds, they don't pay anything in the middle. So it's like interest is accumulated. See, at the end, the interest exists. It's only the disbursement of the interest is what is the coupon. It's not that the interest does not exist. The interest exists. Either it is accumulated. See, it can very well happen. Let's say, for a bond for this period, the interest which is applicable for this entire period, the annual interest that is applicable for this entire period is actually called as yield to maturity of the bond, which is typically equal to the IRR of the bond, internal rate of return. Now, on a yearly payment basis, the company may pay something. It may be zero, which means whatever is this yearly interest that is just accumulated till the last, or they may pay every year exactly this much, which so they are paying off what that year's interest, they are paying off, that's it, right? Or they may pay more than this amount every year, so that finally it may be a lesser, or they may pay less than this. Any of the possibilities are there. It's only the disbursement part. Coupon is only about the disbursement. The interest that is applicable for that period, for that year, is YTM. But every year or every period, what are they actually disbursing is the coupon. So coupon need not be the same as YTM, right? Even for a zero coupon bond, the YTM will still exist, which is an interest of, let's say, 8%. If I say YTM is 8% for that bond, every year it has to pay an interest of 8, but it is not disbursing that 8, it is just getting accumulated. So YTM is about annual interest, whereas coupon is about disbursement. If I say a straight coupon of 7%, but YTM of 8%, actually 8% is what is getting accumulated every year, but only 7% is paid, 1% is is not getting disbursed. Right? That may give you a chance that probably you may purchase it at a lesser price. That is what is called as a discount bond. Because actually interest rate is 8, but disbursement wise only 7 is getting disbursed every year, coupon wise. Right? So probably because the disbursement is lesser than the actual accumulation, so how do you make it 8? Purchase it for a cheaper. Then it becomes 8. If they are giving 7, if I purchase it for cheap, that 1% will be bought from that lesser price at which I am purchasing it. That is what we are calling as discount bonds. Right? Similarly, if they are paying more, let's say 10% they pay as yearly payment, whereas YTM is 8%. Every period they are paying more and more. which means you can, but you have to make it only 8%, which means you will purchase the bond at a premium, right? So coupon is only about disbursement, whereas YTM is the actual annual interests associated with the bond up to the maturity. Annual CAGR, compounded annual growth rate of the bond. Okay. Yeah. Zero coupon bonds are exposed to low reinvestment risk, because you don't get reinvestment risk when it comes when you get something in the middle and you are not able to reinvest it at a good interest rate. Let's say if a bond is there, it pays you 100 rupees every year. If you are not able to deposit that 100 at a good interest, if the interest rates have fallen in the market, that 100, if you are depositing after 1 year, you are not able to deposit at a higher rate. That is what we are calling as a reinvestment risk. In case of zero coupon bond, nothing comes in the middle, only everything is on maturity. So there is no question of reinvestment. Reinvestment risk will come into picture only if there are intermediate payments. That intermediate payments I am not able to reinvest properly because of the interest rates not comfortable. That is what is the reinvestment risk. The interest is based on time to maturity at issuance, and they are originally issued at a discount. Discount means because they are paying much lesser than the actual interest rate, much lesser than the YTM, they should be sold at a discount. So simply put, just as an equation, if the coupon is greater than YTM, we say the bond is issued at a premium. If the coupon is equal to YTM, the bond is issued at a face value or a par value. If the coupon is less than the YTM, the bond is issued at a discount. Here zero coupon means coupon is 0, which is less than the YTM. So the bond has to be issued at a discount. Because it is very, very less, we even call as deep discount. Right? In case of bankruptcy, the bondholder has a claim on only equal to the issue price plus the accrued interest till date. So let's say the company says that it will pay 1000 on maturity, right? So you will purchase it because it doesn't pay anything in the middle. You will purchase it at, let's say, 700, so that after 5 years it will give you 1000, right? Because 1000 is fixed. What you get after 5 years is fixed. This is the face value of the bond. What you get after 5 years is fixed, but you won't get anything in the middle. So unless you purchase it at a lesser price, it will not be profitable. So let's assume you have purchased it at 700. After 2 years, assuming 10% interest or something, 8-9% interest, let's say this has already become 810 after 2 years. Now the company has defaulted. So what is that amount you have to get? You will get only 810 out of it. If the company has defaulted and let's say all the company's assets are sold off to make your payments, you will get 810 only out of that. Right? That's the reason why people calculate all this kind of stuff, because you have purchased it at a discount of 700 and every year the interest that is applicable is your YTM. Based on that YTM of 2 years, let's say it has accumulated up to 810. So that is what he is saying. The claim is equal to the issue price, which is 700, and the accrued interest to that date, 110. 110 is the interest that got accrued during that 2-year period. So you will be paid only that 810 in case of the default of that company. At the end of 5 years, if they are still there and it's a maturity, then you will be paid the entire 1000. Right? So just a few more features. Zero coupon bonds pay no regular interest. Bondholder receives the full principal amount on the maturity date or the redemption date. Zero coupon bonds may be created from fixed rate bonds through the stripping process. We have looked at when we are doing that stripping and finding the spot rate from the bond rates. So where a coupon bond can be split into zero coupon bonds. So if let's say if there is a coupon bond which is paying C and then the principal, I can very well make them as three different zero coupon bonds. One bond which will pay C, another bond which will pay C, and another bond which will pay P on the maturity. And this will have a 1 year maturity, this will have a 2 year maturity, and this also will have a 2 year maturity. So the stripping is a process where we break down a coupon bond into one or more zero coupon bonds for the purpose of trading them, much fine-tuned training. The creditor claim original offering price plus the accrued and unpaid interest till date. In case of zero coupon, nothing is paid during the middle, so everything is accrued only. But in case something is paid in the middle, so the total accrued minus the paid will be taken as a part of the final claim. Yeah. So sometimes, how is the security ensured in these kind of corporate bonds? So, for example, let's say a mortgage bond. Today, this mortgage-backed securities. There are different types of bonds that could be issued, as we discussed. There is one good aspect on mortgage-backed securities. See, today this is a very powerful instrument in the market. Like, for example, lot of individuals have taken loans. So the bank is having a big portfolio of loans of different time periods. Now what the bank is doing is, it is selling off all these loans to a third party. So the third party is purchasing all these loans and giving direct cash to the bank. So bank has secured itself, right? And this third party, what it is doing is, it is issuing bonds to the public. So now look at the flow. The public are buying the bonds. Whatever the money that get pooled into the bonds looks like it is being given as loans through the banks. Right? Now once the EMI comes from the borrower, based on that EMIs that are coming from the borrowers, the bond interest payments and principal payments will be paid. Because it's a chain. Now these guys have borrowed. So it's as good as these guys have contributed to these guys borrowing. If I look at the whole chain, it looks like the investors have contributed to the borrowers borrowing. Now based on what these borrowers pay as a part of their EMIs, the interest and the principal to the bondholders will change. Now here there are so many problems. These guys may default. These guys may do prepayments. Right? They may say, I'll clear off my principal early. Now because of all these things, what happens is, the timing of the payments to the bondholders will be completely ad hoc. Right? Because it is completely dependent on the EMI payments from the borrowers. So again, not many may subscribe to those kind of bonds because they are also becoming risky. So that's where the world has gone even one more step further. and introduce products called structured products, where even, see, probably out of all these loans, 60-70% may be on time. You may assume that 60-70% may be on time. So what they have done is around 60 to 70. So these bonds, instead of creating one category of bond, they have created 2-3 categories. One is extremely secured, right? Because that are paid from the 60%, which are more regular. Some are semi-secured, semi-risky. The remaining part is fully risky, just like your equity. Your interest will be more, or whatever is left, you may even make it equal to equity itself. Whatever comes, you will receive. So you may receive more, you may receive less also. So they have made, instead of making it uniform for all the investors, they have classified the bonds accordingly. That is what today's world of securitization and structured product. I am trying to create a fully, from a risky product, I am trying to create slightly less risky products, at least partially less risky product, and some of them I will leave them as fully risky, which would be paid from this. So there could be some kind of prepayment that may happen. So because of that prepayment, that last tranche, they are typically called as tranches. Tranches are like groups. So the last tranche could be like an equity tranche. Whatever is left, you will receive. Right? So as a part of the mortgage bond, the holder of the mortgage bond, who are these guys? They have the first lien on the real estate property. In case these guys default, of course, these guys will default only when the real estate prices go down. So there is no benefit to these guys. Getting the properties, they can't do anything because they cannot sell them also. Right? But still they have the first lien. The holder of the mortgage bond has the first lien on the real estate property. Then there could be some other form of mortgage bond, which are equipment trust certificates. Trustee will actually hold the property and rents it to the bond issuer. So this entire thing are held with a trustee. Trustee will have the ownership of the properties. He rents it to the bank, who is the bond issuer, or he rents it to the middle party, who is the bond issuer. But again, in case there is a default, these guys will have, these guys can take from the trustee either in the form of cash or in the form of the real estate. Either thing can work out, because now the trustee is the owner. Then the property is often in the form of standardized equipments, buildings, cars, rails, whichever are the what you call the heavy properties, right? The big assets. All those things are the typical properties, and there even the bonds can be issued or debentures also can be issued depending on the credit worthiness of the issuing company. Generally, what happens is this company is a high trustworthy company, mostly either backed by the government or part of the government itself. Of course, though there are a lot of private players in this space, but generally, so what is happening, if you see the process, because this is a very trustworthy company, probably let's say this will give only a 6% return. High risk, less risky, because trustworthy company, given by trustworthy company means less risk. Less risk means less return. So by the time it comes here, it becomes 8%. By the time it comes here, it becomes 10%. So you give the loan to the customer at around 10%. So that is how each one in the process is making money. is at 10%. Is getting only 2% profit. No, but the problem is, see, out of these loans, many of these, see, if I simplify the process, a simple deposit versus a loan. Bank is giving a deposit, taking the deposit, let's say at 5% on an average, and lending at 10%. The bank should get 5% in the process. But because of this process, the biggest problem is the entire risk is borne by the bank, and probably the most of the properties which are collateral are illiquid. So the bank will not get ready cash for any other stuff. So bank still finds, okay, if there is someone who is ready to buy this entire thing, giving me something at around 8%, because there are so many risky loans also. So 8% is again under the assumption that some loans are risky, may not be recovered. So the guy who is buying these loans, he will evaluate the complete loan portfolio of the bank, and based on that he will decide that amount. Right? So bank is fine even if I get 1% or 2% return, because that's an assured one and I'm getting it on the spot. The risk is mitigated. Right. Right. That other company, see, whosoever it is, whether it's a trustworthy company or, see, whosoever is buying it, right? Forget about trustworthy or risky company. Whosoever is buying it, their intention is also to make a profit. So they have to buy it at a lesser rate and sell it at a higher rate. Only then they are profitable. Right? So then they may start saying we'll give only 70% or we'll give only 60% of your, will buy only 70% of your loans. Instead of buying the entire 100% of your loan, 30% are risky loans. So we'll buy only 30%, 70% of your loan. Then the remaining 70% bank has to take the risk. So bank has to produce all the details. Who are the customers? So the entire details are provided, because see, at the end, the bank is, it's like an insurance taken by the bank. In a simpler term, bank is shying away from the total risk, but it is compromising on its profits. If it has not shied away from that risk, probably deposit is 5% and loan is 10%. The remaining 5% is contributing to its revenue. Whereas here, it's not 5% that is contributing to it, right? Because it is foregoing, it is selling off, which means the loan which the customer is paying now will not come to the bank, will come to that third party directly, routed via bank, but it will come via to the third party. Now the third party is taking that risk, just like insurance company accepting the risk on behalf of the person. Right? Now that third party, what it is doing is, again it is trying to mitigate its own risk by issuing some bonds and sending it to the user. This entire chain was the problem for the subprime crisis. This is the only chain which created the entire subprime crisis. Banks were not that heavily bad because they have all securitized. The third parties who have actually bought all this, they have gone fully bankrupt. Bank did not accept secured loans. That is what is the subprime. Bank has given all subprime loans without even checking, because it thought that the property is there as a collateral. It simply thought, even if I give, let's say this is a property worth 1 million, then probably even if I give 80,000, 800,000 as a loan, should be fine, because anyhow I have a 1 million property as a collateral. That is the way the banks acted, irrespective of his paying potential. Right? Irrespective of his paying potential, the bank has acted that way. So what has happened, once the real estate prices have fallen, that 1 million property has become 600 or 700,000. Collateral worth is much lesser than the loan to be paid. So huge default started. Whereas in the meanwhile, bank has protected itself, but all these third parties which have written these mortgage-backed securities, they are the guys who have completely in risk. That's where insurance operations of lot of insurance companies have acted as these third parties. Lot of government companies, there were two big agencies, Fannie Mae and Freddie Mac. They were the two major US organizations which were into this writing process. They are like loan underwriting wise, they are some of the biggest companies in the US. They are the government backed agencies which have got bankrupt almost, because they have underwritten all risky loans, and there was a political pressure to write risky loans. So that entire thing created a bigger problem, and almost they got wiped off, few billions and billions of dollars. AIG was one more, complete out of the business. So few insurance companies were very badly impacted. Owners of debentures must have a claim. Okay, debenture, or depending on what is the trustworthy company, whether it can issue either a debenture or a bond. Okay, I think this entire thing we have looked at, but just let's go through line by line. A bond that is secured by mortgage on one or more assets. These bonds are typically backed by real estate holdings or real property such as equipment. In default situation, mortgage bondholders have a claim to the underlying property and could sell it off to compensate for default. Offers the investor a great deal of protection in that principal is secured by a valuable asset that could be theoretically be sold off to cover the debt. But the only problem here is like this kind of situation where the loans are very risky. In these kind of cases, the mortgage bondholder will lose heavily. And that too, in that also, the third category guy who is more of an equity tranche holder, those are the guys who will lose very badly. When they gain, they'll gain very badly. See, in these actually calculations, people even do a calculation where they assume that some percentage will definitely default. Even beyond that, if the defaults occur, that is where the whole losses will start mounting. Yeah, then we have a collateral trust bonds, as the name itself is saying, they are backed by any collateral. It need not be only real estate property or something. Any asset could be a collateral. For example, credit card receivables. If a credit card company has so much of card receivables, it may sell that entire thing to a third party. Someone else will take the ownership in terms of collecting all that credit card payments. So today these third party transactions, and from their issuing of the bonds through various kind of mechanisms, is becoming a very common aspect. Like for example, if we see company A issues a collateral trust bond, as a collateral for the bond, it includes the right to the company A shares held by the trust. So I issue a bond by keeping shares as the collateral. In case I default, you will get the shares of the company. If the share price is down, then you are completely out. Today, there are so many loans that are given even to the CEOs of the companies against their shares itself. Probably may or may not be, you may have heard of these things. Most of the companies here, most of the big major companies in AP, almost all their MDs or CEOs, they have pledged 90% of their shares at least. Especially the likes of GVK, GMR, more than 50 to 60% of their shares are pledged with the banks. There are some companies like your, I think GVK only, or there are few more cement-based companies and all, where more than 60, 70, 80, even 90% of the shares of the promoters are pledged with the banks. So it may so happen that if the share price falls, which is happening in the last few days, the share prices fall drastically, you may even find a change in the ownership of the company also. Which is one of the, even the Kingfisher, the similar kind of a story has occurred. So almost all the promoters, their shares are getting pledged, which is one form of this CTB. But CTB, in a sense, some kind of collateral. I could still have my shares kept as a collateral. The entire shares of the company can be kept as a collateral to issue bonds. As long as the share price is going up, there is no risk with it. But once the share price starts falling, looks like a big risky investment. Then we can even talk about the equipment. As the word itself is saying, this is for the equipment. Equipment we call as equipment trust certificate. So the equipment will be kept as a collateral. The debt issued is secured. So against everything as a collateral, I can issue bonds today. See, at the end, what is required for a bond issue? My capacity to pay. Right? If I am issuing a bond, I'll get money. Everything needs to be looked at as my capacity to pay back. So I need to put something as a collateral for that. In a real estate property, I'll put the property as a collateral. In a shares kind of stuff, I'll put shares as a collateral. Just like borrowing. Bond is nothing but borrowing. Right? Or in case of equipment trust certificate, I'll put equipment as a collateral. Now, with the equipment, what can happen? The equipment can have depreciation. The value of that equipment can keep going down year over year. So, before the equipment value becomes zero, the whole loan payment has to happen. Otherwise, that equipment will not have any value. Let's say I have a machine and I have put that machine as a collateral and I have borrowed some money. This machine with the usage, this value becomes zero. Let's say I have kept my car as a collateral to borrow some money. Now, car over a period, its value goes down and down and down. Now, if my loan is for a 10-year period and the car works only for 3 years, no one will pay the loan after 3 years. That's where typically the car loans are given only for a short period. Right? They are not given for a 10-year period, whereas housing loans are given for 20-year periods also. For the simple reason that equipment or that kind of a machine may go to zero value within a few years. And still if the loan is outstanding at the end of that period, probably the defaults are much, much higher. So you have to make sure that the loan amount outstanding at any point is always lesser than the worth of the collateral you are having. That's why even in a property loan, if your property is worth 50 lakhs, the banks will say we'll give loan in only up to 35 or 40 lakhs. Because the collateral which they want to give, they say you have to make a down payment of around 10 lakhs. The reason why they talk about all this stuff is they have a collateral which is more stronger than the loan that is outstanding to secure themselves. Right? The moment at any point in time the value of the asset is more than the worth of the collateral, there is a good chance of defaulting. So there could be a debenture bond, which is typically issued by a government. Again, against all kinds of securities, but it could be a unsecured kind of a bond. See, the difference between secured and unsecured is you have a collateral to back it versus you don't have a collateral to back it. That is what is the difference between a secured. So debenture carries no collateral, and that's where we are calling it as unsecured. Whereas debenture holder gets the credit. Okay, here the problem is, if it is a debenture, if the company goes bankrupt, the debenture holder will get an access slightly on the lesser priority. The bond holder will get the more priority on the claim. The debenture holder, who is an unsecured, who is a risk-taking guy, will get the next priority in terms of the payment. The higher the secured the instrument is, the higher would be the priority in terms of the payment, in terms of a default. Right? Debentures issued by the government still are risk-free. Yeah, there could be a guaranteed bond. Interest and principal on the bond are guaranteed to be paid by the firm other than the issuer of the bond. Someone else will pay the interest and principal, again a third party, which could be on mortgage itself or anything else also. It's like, I have issued the bond. The moment I issue it, I'll sell it off to a third party. So my role is only in terms of issuing it. That's it. I'll sell it off to the third party. He will purchase my bond probably at a discount. This entire bonds he will purchase at a discount. The interest and principal payments have to be paid by him. It's like, I have raised the loan. I have given that loan to someone else for doing his business. I have put that in a subsidiary company. The subsidiary will be responsible to pay both the interest as well as the principal. The guarantee limits the impact on the bondholders if the issuer of the bond goes to default. So here the biggest, this guarantee, whatever is there, if at all I default, see, typically the credit default swaps and all as instruments have come up primarily to produce this. See, it's like, okay, a very risky company has raised a bond. Probably I am issuing a bond. I got capital. Now, people may not trust me. What is this kind of a company? Right? Will it return back the interest and the principal or not? So what I'll say, I'll bring in a guarantor. In case I default, he will pay the interest and the principal. Probably a bank will act as a guarantor, or some other company will act as a guarantor. See, for example, just look at it like this. One new company came up for doing some project. Right? Or even in a better terms, for example, there is GMR Holdings, which has set up a new company for building an airport. Right? These two are never linked. This is another company where GMR has pumped in some capital, but otherwise it has its own legal existence. Now, any loan will be taken by this company. This is typically called as a special purpose vehicle. This company will exist only until the airport. Once the airport construction and operations, today most of the projects go on a PPP mode, which is a public-private partnership model. So the private company will own it for a certain period, operate it for a certain period, just like your GMR Hyderabad airport. GMR has built it. It will operate it for 30 years. It has a 30-year lease period for operating. And after 30 years, the entire thing would be handed over to the government. So during this period, whatever comes, so for this 30 years, GMR has come up with a new company. Instead of dealing the entire finances within the scope of this GMR holdings, it has floated a new company called GHIAL, GMR Hyderabad International Airport Limited. So any loan, this company has borrowed close to 2000 crores loan for building the airport. Now, so this loan or bonds can be looked at in a similar manner. This loan, if the banks or someone has to be given, okay, this is a new company, right? And GMR has put only some around 300 crores or something into this company. That's it. But the loan is around 2000 crores. Now, the loan can be more easily granted if there is a guarantor. If GMR says, if at all this company cannot pay the principal and interest, you can take it from my GMR holdings. That is like a guarantor. Right? The same way the bonds, loan or bond. See, at the end it is like borrowing. Even if this company has issued the bonds for 2000 crores, probably people may not trust this company directly, because one, it's a new, two, lot of other headaches and all may come for this project. Because of that, people may not be interested. Then if GMR acts as a guarantor to this kind of stuff, then I'll say that this bond is a guaranteed bond. If at all this guy is defaulting, this guy will be paying for it. So this gives a trust in the borrowers. Sorry, lenders. This gives a trust in the investors or the lenders that, yeah, I mean, even if this company is a new company, even if this guy defaults, we'll get it from here. This company is still a, see, they don't want to spoil their ratings and their entire stuff. So generally they create new companies. This is a very common aspect. Special purpose vehicles for all long-term projects. Any project finance goes with the creation of the special purpose vehicles. Right? Metas is a separate company, and it's it was entirely owned by Satyam Group itself. It's not. It's actually not a special purpose vehicle. See, when I say special purpose vehicle, the timeline of that company is limited. It cannot go public. It's a private company. The timeline of it is pretty limited, only for a specific purpose. But Metas did not come up with that objective. See, you can see. Let's say you have to borrow 2000 crores now. If that 2000 crores is shown as a loan in the balance sheet of GMR, the entire financial performance of GMR will be affected. So shareholders, share price will be damaged. Lot of things will happen. The moment you see a big number, because these are heavy projects, the revenue from this project does not come for first 5 years. GMR Airport started building in 2003. The first operation started in 2008. So revenue does not come for few years. Expenses are there. Profits will go down. So the more and more every year profits going down, shareholders may back out. So the entire worth of the company itself will go down because of that. So generally for long-term projects, the advisable stuff is, or there is a permission given that you can create your SPVs and the entire borrowings and everything. It's like a private limited company. So no investors, see, because it's a private limited company there, the headache of the investors, oh, I need 15% return, those things will not be there. So with a lesser cost of capital, you can still execute your project because it's like a private company. And for GMR, okay, it has just invested that 300 crores into that. So it treated as a small investment in that. So if that company is profitable, it will get its dividend. Otherwise, it will not even get that dividend. Only the dividend loss will be there. But it would not be a huge loss or impact on the financial statements of the company. Because that's a company in itself, 2000 crores. How many companies have that much of stuff? So it's always worth enough to float it as a separate company itself. Yeah. Now, there are provisions where a company can retire its bonds before maturity. That is what is the calling back. Or see, let's say I have issued bonds for a 10-year maturity. But after 5 years, I may think I'll pay them back. But that has to be mentioned in the indenture very clearly. After 5 years, there is a possibility that we may call back the bonds. If that is not there in the indenture, company cannot do it for 10 years. There is a 10-year maturity period. So every bond indenture, if at all it can be called back, there definitely needs to be a mechanism. It has to be mentioned in the indenture. So in that, one could be a call provision. I can call back the bond. After 5 years or after 7 years, they'll say, after 5 years, we'll pay lump sum this much and call back. So you surrender all your bonds, we'll pay this much. After 7 years, it's not an option to the investor. He has to surrender it. Right? After 7 years, they may put some 2-3 deadlines. And all these are within the hands of the company, not with the hands of the investors. So that is one way they can reduce the maturity period. 2, they can pull in sinking fund provision, which is like, let's say you have taken 100 crores. They may say every year we'll pay back 10 crores. So we'll reduce the amount of loan. The principal amount of the loan will reduce slowly, gradually. So 10%, instead of buying back everything after 5th year or something, we'll say we'll do a 10% buyback every year. That is like a sinking fund provision. Our fund value, or the loan outstanding or the bond value outstanding, that is going down. That is the sinking fund provision. Or there could be a call provision. Yeah, call provision wise, it is generally a big problem to the bondholders. But sinking fund sometimes may be beneficial to the bondholders, because every year they buy out 10%. See, generally, when will the company buy back? When the interest rates in the market are very, very less. Because today it has issued bonds, let's say at 10% interest, which means every year it has to pay 10% interest to its investors. But irrespective of whatever are the market rates. Now let's say after 5 years it has found that the interest rates in the market are only 6%. Then what it can very well think is, it can call back this bond and reissue them at 6%. So the company will save on that. So generally when the interest rates in the market are much lower, only then they will exercise the call option. And if in this 10 years the interest rates have not gone lower, they will not go for a call option at all. Today, probably any bond that the company has issued in the last 1-2 years, there was a definite call option. Whereas 4-5 years back, any bond that the companies have issued, there was no call option. Because 4-5 years back, the interest rates were pretty low. So there is no way the interest rate can go even lesser than that. So there is no point in going for a call option. So the companies did not issue any call option in their bond. Whereas now the interest rates are high in the last 1-2 years. There is a good chance that they will go down. So they started putting the call option on the bond. Just one sec. Yeah. So if there is a call provision, the company can call back the bond. And this will typically act against the bondholder always. Because for the 10 years he thought he would have got 10% interest, but now he is getting only 6%. Or he has to surrender it after 5 years. And after that he may not get the same 10%. So it always works against the bondholder. But if there is a sinking fund provision, it can still work better for bondholder, because every year the company says that they'll pull out 10%. They'll pay 10%. So it might be during a period of increasing interest or decreasing interest. There's no here it's a mandatory thing for a company. If they go for a sinking fund provision, if they specify that we'll buy back 10% of the bonds every year, whether the interest rates are higher or lower, they have to buy back 10%. So if they have bought it at a higher rate, if the interest rates were higher, it is beneficial to the bondholder. If they have bought it back when the interest rates were lower, it is not beneficial to the bondholder. So sometimes sinking fund provision can still benefit the bondholder, whereas call provision will never benefit the bondholder. Right? Then the bond issuers can even retire the debt through a tender offer. Even initially, they did not mention anything as a part of their indenture that they will call back or they will put a sinking fund provision or anything. But after that, they may simply give a tender offer asking the investors to surrender their bond if they want. So this will be in the court of the investors. If they want to surrender, they can surrender. They'll give something slightly more. They'll say we'll pay, instead of 1,000, we'll pay 1,005. Something extra as a tender offer. If you want to surrender, you surrender. So here it's not a mandatory thing from the investors. Here it's an optional thing to the investors. So this is more beneficial to the investors than the bondholders, because if they want, they can surrender. Otherwise, they need not surrender. And there could also be a maintenance and replacement fund. So if at all something has to be paid back and all, there should be some fund, especially for sinking fund or whatever. So which means they will maintain some kind of a reserve, which will be used for paying to call back the bond. So cash is used in the fund is used to retire that debt. So it could be done at that tender offer could be at a fixed price or slightly different from the market price, slightly above a market price. So today if you want to buy, 3 rupees above the today's market price. You want to buy after 1 month, 3 rupees again above that market price. So it's not fixed, it's slightly over and above a particular rate. So we have discussed call provision on a bond allows the original issuer to repurchase and retire the bonds, call back the bonds, repurchase them and retire. Typically come with a time window. They'll say after 5 years we can call back, or after 7 years we'll call back. Specific price. After 5 years if we are calling back, we'll pay this much. After 7 years if we are calling back, we'll pay this much. Callable bonds will pay a higher yield than a non-callable bond. Because because the company is taking a advantage, they have to sell it at a discount. Otherwise, no, because company is taking the benefit, right? If the company is taking the benefit, why will investor invest in that? Unless it is available for him for cheap. Right? So callable bonds generally will be sold at a discount compared to the non-callable bonds. And a bond will almost always favor the issuer. Unless it is a convertible bond, or unless it was a tender offer, except for 1 or 2 here and there. Otherwise, most of the time, all the provisions which the issuer will keep in the bond will be from the perspective of the issuer, or which will benefit the issuer, not the investor. It doesn't, if it does not, the issuer will simply continue to make the current interest payments. He will not call back. He'll just continue with the existing bond. If the interest rates are not falling typically, the issuer can simply stick to the existing bond itself and he will not call them back. Call options on bond will be exercised by the issuers when the interest rates are going down. Issuer can simply reissue the debt at a lower cost. That's prime reason. Then in this, make whole call provision, which is a complete, to pay off the remaining debt, the entire debt whatever is there, pay off completely. That is what is the make whole. In that provision, a lump sum payment, the borrower has to make a lump sum payment based on the NPV of whatever are outstanding. See, you are retiring it in 5 years. 6th year you have to pay something. If it was there for 10 years, you have to pay something in the 6, 7, 8, 9, 10. So you take the present value of all those future payments, which is the NPV of them, find out the NPV of all those future payments and then retire. And you pay that much amount and you retire them. So it's not a market price which you pay in that. The difference between a regular call and a make whole call is you will pay only the present value of all the future payments that are yet to be paid on that. Right? Let's say you have to pay 100, 100, 100 for the next 5 years and 1000 on maturity. You find out the present value of all those things. That is what you will pay today to pay off that complete bond. Make whole call will be defined in the indenture. That entire thing will be present as a part of the indenture. Only then it could be exercised. If it is not present in the indenture, the call or sinking fund cannot be exercised. In that case, they have to go through a tender offer. Fine. The issuer does not expect to have to use this type of provision, but if the issuer does, investor will be compensated, made whole. Depends on. So sometimes they may go for a lesser purchase, whatever it is, because depending on that, the investor will think whether because they will be there as a part of the indenture always. The investor can very well think whether he can invest in it or not. Right? The indenture is available at the beginning of the issue of the bond itself. Then the investor himself can think, oh, this is what is the provision that is there. If I want, I will purchase it. Otherwise, I will not purchase it. That's where the investor is made to read through the entire indenture before taking his decision on the purchase of the bond. Sinking fund, we said, a periodic retiring of the principal, let's say 10% every year. So every year some portion of the entire principal is paying back. So every year, let's say 10% or 20%, he'll mention that again as a part of the indenture. Rather than repaying the entire principal on the maturity date, buys back a portion of the current issue annually, used at a fixed, generally at a fixed rate, 5%, 8%, whatever it is the amount that is fixed. Some percentage of the bonds are being bought back and the remaining are closed on maturity. So probably 50% he'll say I'll buy back before maturity, and only 50% I'll pay on the maturity date. So if the interest rates are falling, it will benefit the issuer, but if the interest rates are increasing, it will benefit the investor. Tender offer, as we have seen, an offer to purchase. So it just like a shareholder, in case of shares, just like a tender offer is, you make an offer, probably through newspaper or sending mail to your investors saying, you please surrender your shares or bonds, we'll pay this much per each bond. So the ball is in the court of the investors. If they want to surrender, they'll surrender, close the bond, they'll get the proceeds. Otherwise, they may continue the bond until maturity. So tender offers may be friendly or unfriendly. Require any corporation or individual acquiring 5% of the company to disclose the information to the SEC. Because sometimes it may be played in a gambled way also. Because if someone is having a very high proportion of shares, to increase the price, they may ask this issuer to pay a very heavy price to make sure that they are purchasing, they are able to sell back all their bonds, and the company may go into big losses also. Yeah, in this there are risks. One is a risk with respect to credit default, because I have issued a loan, I may not get it back. I have issued bonds, I may not get it back. So that is the credit default risk. They do not make the payments on time. And credit spread risk is the rating of the company. Let's say I have issued the bond. When I have issued it, my rating was AAA. But over the period, it has gone to, let's say, AA or A or B. Then I'm becoming more and more risky. Actually, to compensate for the risk, I need to get more return, but this company is nowhere increasing my return. So in that case, I am exposed to a credit spread risk. The spread is going up because the company is becoming more and more risky during this period. If it is a risky company, generally what we see also, if the credit rating of the company is very less, very poor, they'll generally pay a higher return. Highly secured company which is having a AAA rating, they'll generally pay a lesser return because they have less risk. So what we typically observe is, okay, while issuing this bond, let's say this company was at AAA, so it has even if it had issued at around 8% or 8.5% interest, people have subscribed to it. But over a period, it has become more risky. So probably when it has become B rating, probably it should have given 10.5% return, but it is still giving 8.5. The 2% you are losing because of the credit spread that has occurred during the period. That is what is the credit spread risk. So you are receiving the money, but not the fullest of what you have to receive from this kind of a company. Right? And there is also a possibility of event risk. This is where the indenture will even talk about no major events need to be planned as long as the bond is in place, especially mergers and acquisitions. This company should not acquire some other company. This company should not be acquired by some other company during this meantime. The reason being, if you are acquiring someone else, you will have to pay a huge cash to acquire them. Your cash flow will be impacted, or even after that your profitability will be impacted, and there is a good chance that you may not be in a position to pay your existing bondholder better, or the new one may supersede this bond in terms of the priority of claims. So because of all these things, the indenture will clearly mention what all the investor will do and what all investor will not do until the maturity of the bond is over. Because there are so many event risks that are possible, especially with a merger or acquisition or something. Because of that, the paying capacity of the company may directly fall down, because now you have acquired some other company. So that's where sometimes when a company is issuing a bond, very recently when I have purchased the Shriram Transport Finance bond also, I have clearly seen they have written as a part of their indenture that this money will not be used for any acquisition purpose. That's exclusive. That exclusively for that. See, you have to mention clearly. The indenture we are saying is, see, if you are raising a normal corporate bond, companies will not raise bonds to purchase some other companies. They take loans to purchase some other companies. So banks will intermediate in the process, but not the general public. Very rare. But here, if the company is issuing a bond for, it has to clearly specify the purpose of the bond. Every indenture will definitely contain the purpose of the bond. Probably I'll show you the Shriram Transport one. Right, where they have clearly specified they will not use this for these purposes. For any other purpose, they can use this money. That also they have written. Right. So the risk due to unforeseen events is an event risk, because it's not about credit default or something. Some kind of merger occurring or some kind of weather related stuff, natural calamities related stuff occurring, And because of that, the risk goes much higher. That is what is the fat tails, which can be linked with your statistics, where there was a kurtosis kind of distributions. So identification of the high kurtosis distributions is what is the identification of the fat tails, and based on that, taking your risk management measures. Indenture can try to address some of these events, but some can be omitted and lawyers can find loopholes around them. See, probably an insurance contract, if we see, they'll have to specify each and every event under which they will make the payment. If they try to omit one single line, people will try to identify it and lawyers can take it at their advantage, and finally the claim can be paid. Here also, every single scenario in which the bond payment will occur and will not occur, they have to be very clearly specified. What all events are excluded from this risk or from the payment. If something is not mentioned, they are subjected to that risk. Right? Then the other category of bonds which we see is junk bonds, which are otherwise called as high yield bond, which are more like issued by very risky companies. They don't have a good proper credit rating, right? They are very high risky. At the same time, they have to give high returns. That is why they are called as high yield bond. You will get big returns by growing risky firms. They don't have too much of credibility associated with them, but they still have the potential. They are ready to borrow at a slightly higher rate. That is what we are calling as a high yield bond. So they are like at one point in time they were investment grade bonds or good AAA, AA rated, but over the period they have fallen, and now again they want to bounce back. Even those will go as a part of, just like your wild card entrance. Just like that, they want to again bounce back. They are restructured the company or something. They are taking some extra risk, but at the same time they will have to give a higher return. So that is where, while doing the leverage buyouts and all, companies, if at all they are going for a bond, they will go for this high yield bond, because it will not get a proper credit rating. It will get a very bad credit rating, even though it is issued by Tatas. For their other bonds, they will get a very good credit rating. But for these kind of bonds which are used especially for buying out some other company or something, they will not get a proper credit rating, which means they have to give a higher return for those kind of bonds. High yield bonds may have coupon structures, so they can have deferred interest bonds, which is for the first few years they will not make any coupon payment. So they'll say after 4-5 years the first coupon payment will occur, probably a higher coupon, but they'll defer it, because in the first 3-4 years they may not get good profit, so they cannot pay the interest, so they'll put it as deferred interest. Or they'll say step up bonds. First year we'll pay only 4% coupon, next year 4.5%, next year 5%, next year 5.5%. So slowly they'll increase the coupon. Instead of a fixed straight coupon across all the periods, they'll do it as a step up. Or sometimes it could be a payment in kind of bond. Instead of giving it in the form of cash, they can give it in form of some other gifts or something, or some kind of association, memberships, various other forms in which gift vouchers or some kind of thing where it is not actually a cash, but some of their products. So there could be a default rate from the issuer. So we are talking of, if I use the word issuer default rate, it could be in percentage terms or in the dollar terms. The dollar terms is called as the dollar default. So let's say you have issued 100 bonds, or you have issued 10 times. How many times you have defaulted? That is the issuer default rate. Proportion based on the total number of issues, a default as a proportion of the total issues. So if you have issued 10 times, how many times you have defaulted. Whereas dollar rate wise, if you have raised a bond for 100 crores, how much has been defaulted? 20 crores, 10 crores? Default by company. All this bond is default by company itself. Investor will not default anything in this. Investor has already given his money. He has to get back his money. Yeah. It will be negative itself. The company is not doing well. Where will they pay from? That is what is the problem with Kingfisher today. If the company is not doing well, where will they pay that from? Right? They have raised a huge, they borrowed heavily from the public. Right? Probably for you, it may look like I have given only 25,000 to purchase 10 bonds. But like you, there are another lakhs of people who have purchased, which means they all put together, you have paid few hundreds of crores to the company. Now, if they can't generate the profit out of that, it's as good as they have defaulted. Now, you have to get some portion of your, that 25,000, something you have to get back. So, if I say, oh, you have recovered 20,000 out of that 25,000, 20% is the dollar default rate. Because the company has defaulted around 5,000 out of every 25,000. So that is what is the dollar default. So on that I can even find out the average annual default rate. On all the defaulted bonds, what is the dollar value by the total amount that was issued. So that will give the rate of default. Both in percentage terms, in issuer default is in terms of number of issues defaulted. Number of times you have issued the bond and number of times you have defaulted. Whereas dollar default is amount for which you have raised the bond and the amount you have defaulted. Both are important to evaluate the credit worthiness of the company. And whenever you are defaulting, there is a recovery rate, which is nothing but, okay, in case you default, you say I cannot pay the principal or interest. What is the next alternative? I sell off all your assets. Because I have a first hold lien on all your assets. I can sell off all your assets and take off some money. That is what is my recovery. What is that portion I can recover? 80%, 75%, 60%. Depending on what assets you hold, what is the market value of those assets you are holding, that much amount can be recovered. So that is what I call as a recovery rate. And in the recovery, each kind of bondholder will have a different priority. A secured bond will have a high priority than a debenture. Debenture will have a high priority than a junk bond. Right? In all these, probably the secured guy, what is the amount he has to get? He is more senior. So that is the seniority part. Who will get the first claim on all the assets? So probably he may recover the entire 100%. The next layer guy may recover only 80%. Whereas the junk guy can recover only 50%. So there is a recovery rate that is associated. It is stated as the percentage of the debt's par value, which is the most common practice. 80% of the total amount which you have lent or which has been raised as bonds. So that is what we call as a recovery rate. Recovery or I can state it as a percentage of the market value, but generally it is expressed as a percentage of the loan that is borrowed or bond amount that has been issued. In the event of default, the recovery rate refers to the amount a bondholder receives as a proportion of the total amount owed. Bonds with higher security have higher recovery rates, and junk and high yield bonds will have the lower recovery rate.